So we're going to be starting with allocating your portfolio properly, especially if you're working with over $100,000 and up to $1 million and even beyond the $1 million mark. Allocating your capital is very important. As I scroll through some of my positions right here, you're gonna notice that I have a whole lot of different positions and they are in different sectors. And that's my number one secret. A lot of people blow up their portfolios. They lose a lot of money. That's because they don't understand how to allocate their capital correctly. There are 11 different sectors in the S&P 500. There's information technology, there's healthcare, there's financials, there's consumer discretionary. So consumer discretionary stock, for example, is Starbucks. There are industrials, there's communication services, consumer staples, energy, utilities, real estate, and materials. You get the point. There's a whole lot going on in our economy. In fact, if I go to the S&P 500 right now and I click SPY, you will see that there's a whole breakdown of SPY in terms of what it's holding. So as you can see, technology is a big component of the S&P 500, and that's a good thing for me because I was a technology and a software analyst on Wall Street. I was also doing a lot of consumer analysis. So I was looking at restaurant stocks and I was looking at different brands, and I have a very good understanding there. But the secret to having good returns without a lot of volatility, and for me, it's pretty clear. Like if I go to my year to date, I'm up 9.29%, okay? If I go to SPY right now, you will see that year to date, SPY is up 7.5%. So that is Q1. I have locked up Q1 by beating the S&P 500. And just so you know, over a 15-year period, the chances of beating the S&P 500 for fund managers, people with finance degrees, physics degrees, mathematics degrees, the smartest people, quote unquote, the smartest people in the world, right, that are the hungriest for making money, only about 10% of people can actually beat the S&P 500. And these are the best people in the world focusing on the market full time. So clearly beating the market is a very big deal. And a lot of people think that it's very easy, but it's not. If you can beat the market, especially with less volatility, that's the key. Nobody understands this. Everyone thinks about how can I make more money? Well, actually, if you maximize the amount of money that you make per degree of risk that you're taking, that's the actual ratio that you want to go after. It's called the Sharpe ratio. And I always want to maximize my Sharpe ratio. So for example, the S&P 500 here went up 7.5%, but as you can see, it's fairly volatile. If I go to my portfolio, it is a lot less volatile. I am not seeing as big of a detraction when the market goes down, but I'm still getting a good return. In fact, I'm getting more return with less risk. So my Sharpe ratio, hands down, is beating the S&P 500, which means that it's beating probably around 95% of Wall Street. So it's very important for you to listen up and actually look at what I'm teaching you here, because this is really more important than just making a lot of money. Anyone can make a lot of money by just buying call options before earnings. I mean, there's a lot of people doing that and you can make short-term money, but how you actually build wealth is not through short-term action. It's through long-term action. It's through consistency. It's through stability. It's by becoming a very steady trader. And I've always said this, if I can make $100 to $500 a day, I'd rather do that than make $2,000 one day and lose $1,000 the next. Like, sure, you may make more money, but long-term, it's a lot more stressful. And in the long term, honestly, just having more consistency is going to be better for your lifestyle. Like for me, I travel and I use money. And a lot of people might ask like, hey, like if you're hitting an all-time high, why is your portfolio only 2,036,000? That's because, you know, I'm being really transparent with you. I am withdrawing money from my portfolio all the time. I just had to pay my team for my Discord community. And yeah, my team's expensive. So I took out 50K and I took out 35K, you know, to pay all my employees. And, you know, for me, I am hitting an all-time high in my portfolio. I had to take some money out for my living expenses and my business as a coach, but you know, I'm being very transparent with you. I'm hitting all-time highs and I can continuously do this for the past 9 years. And most people are not doing this. Most people are just showing you their wins, they're not showing you their losses. And I think it's super important to be transparent. It's also super important to understand that you need to have asset allocation, okay? This is something that is just not taught to anyone, okay? Most people will not even mention what asset allocation is, okay? But if you have over $100,000, you have to put your assets in buckets, okay? So again, if I go back to S&P 500 ETF, I'm gonna tell you what the buckets should look like, okay? And actually, they should look more or less like this. So if you have $100,000, I would put about $25,000 to $30,000 in technology stocks. For me, I am heavily weighted in technology stocks because I understand technology very well. And me personally, I have no healthcare, and that's because when I was working on Wall Street, I was with 9 analysts. So there was 9 analysts in these sectors, and that's because the consumer analyst was both consumer cyclical and consumer defensive. But I had 9 analysts with me, and the only analyst in the office that had a PhD was the healthcare analyst. So she had a PhD in biophysics and biochemistry. And for me, I don't have a degree in that, so I'm not going to pretend to be, Mr. Genius over here, because I'm not, okay? I have expertise in technology, and I'm going to avoid healthcare. And the fact of the matter is, I think most people invest in healthcare trying to get rich quick with, hey, this healthcare company is going to have an FDA approval. I think it's going to go up. That is really silly in my opinion. You are going to put your hard-earned money in a maybe, that this is going to have a maybe FDA approval? I mean, come on now. FDA approvals can take multiple years, and if you don't have expertise in biology, chemistry, or a hard science, I don't personally think that you should be investing in healthcare unless you're investing in a safe company like Johnson & Johnson, okay? So if you have a lot of money, it is very silly for you, and it's also very bad for option trading to go after these healthcare companies. So for example, like J&J is gonna have very healthy options. They're gonna have a lot of option volume. As you can see in the 1 year chart, Johnson & Johnson is currently at 155, and it's very low. It's very low. In fact, and if you look at the dividend yield, it's very good. So this is exactly the type of stock that I would just buy and hold, and that's it. I would just hodl Johnson & Johnson, and I would not invest in single healthcare stocks because they're very risky. I would pick a market leader in healthcare, and I would just say you have 100K, I would just dump 15K. I would do I would start the wheel strategy. To be honest with you, I would go ahead and go to trade J&J options. Straight up, what I would do with 100K right now if I had that in cash. I would go to Johnson & Johnson. I would go out about 30 days. There's nothing wrong, by the way, with going out about 30 days for options. I think it's a, kind of like a myth that you have to do short-term trading. And in my Discord community, we have a very active group for 0 days to expiration. I think that's fine, especially if you have more capital. If you have 100K, that's fine. You can definitely do SPY trading, and I'll go over that shortly because I'm going to talk about every single strategy that you should have in your portfolio. But the majority of it should honestly be the wheel strategy. For me, I think that folks can retire with a few $100,000 in the wheel, because the wheel is the most consistent passive income strategy. And I love going out 30 days. Nothing wrong with 30 days. You set it and you forget it. You don't touch it. And it's already proven that teachers, just your regular math teacher, your English teacher, writing teachers, whatever, in high school outperform financial professionals. Let me say that one more time. Teachers are better than Wall Street, quote unquote, geniuses with physics degrees. These guys that went to Harvard, Yale, Stanford, and the other Ivy League colleges, UPenn included. So these professionals are not actually having the best of returns. They are just not. They are falling flat and not doing so well, versus teachers who hodl and buy high quality companies are doing much better. So, this really ties into my option trading strategy, which is really around the wheel. So what I would do, for example, is J&J, okay? I'm gonna go down 30 days out. I'm gonna look for about a 1% return. Right here, this is perfect. I know 1% might not sound like a lot, but it really does add up. If you can consistently make 1 to 2% a month on a mil, that's fine, right? That's 10 to 20K. Of course, you can make more, because what I'm gonna discuss is different strategies, and some other strategies are a bit higher leverage. I will be talking about leverage and margin in this video. But first of all, I would stick to the safest stuff, okay? If you want the most safety, the lowest volatility, they call it variance in finance. They call it variance. The amount of movement you get in a portfolio is variance. I would just sell puts. So on J&J, I would expand this option. The volume isn't huge, actually, which is actually very shocking to me. I would think that Johnson & Johnson would have thousands of volume just like Apple. It may be because this is an unconventional expiration day. Options do expire traditionally on the 3rd Friday of every month. So, let me go to May 19, which would be the traditional expiration day. And now, yes, as you can see there's a whole lot more volume. There's a whole lot more open interest. So this is very healthy. And the bid-ask spread is, it's not ideal. I want to see a bid-ask spread that is maybe $2, $3, or $4 tight. This is about $12. So it's not ideal when you're basically trading this. You are basically losing about $6. There is a gap of $6, so you're losing $6. And again, this is actually why I don't really love 0 days to expiration trading, because, in theory, even if there is a gap of $2, you're still basically losing about $1. And if you do that every single day, it's $1 a day. I mean, it's not a huge deal, I guess, but in a month, that's $20. That's $240 a year, which is not a lot if you have a bigger portfolio, 100K to a mil. But it certainly can add up to maybe $1,000 in slippage. That's what I want to call it, slippage cost, which is the difference between the bid and the ask spread. So even though, let's say you're using Robinhood or Webull or whatever, right? There's so many of these platforms out there. The platform doesn't matter, right? It's just a vehicle to get you to trade, right? Even if you're using a free platform, there is still slippage cost, okay? That's something that people don't think about, which is why I don't really like 0Ds to expiration strategies. Now, they can be very profitable, and I do them from time to time, but again, majority of your portfolio should be the safe strategies like the wheel if you have more money. Now, if you have a smaller portfolio, you obviously want to watch my spread video, which was a master video on just spreads, how to scale with spreads. But with bigger portfolios, you can't do spreads for all of your portfolio. Like if you have $100,000, it is completely silly. Like absolutely, like you're just uneducated if you're going to do $100,000 all in spreads. Like you're completely out of your mind unless you're from a really wealthy family and that 100K doesn't mean anything to you, then sure. But if you're worth 200K and you have 100K in your portfolio, you would be very wise to be very diversified amongst your option trading strategies and amongst your sectors and even amongst your geography. So what I'm going to talk about in just a second is I'm going to go into my portfolio and show you why I invest in things like NEO, BABA, and recently JD.com. It's because I want to be as diversified as possible because I'm working with $2 million. That's my lifetime earnings, my net worth, my savings, my everything, right? I can't afford to lose this, which is why I'm focused on consistency. I teach consistency somewhat from a selfish angle, which is that's what I do. And I wouldn't really say it's selfish, but I just want other people to be, similar to me. This is what's important to me is to be consistent. Now, some people might want to be in the casino or the lottery, and I hope I don't attract those type of people. I want to attract people that are saying to themselves, hey, I don't want to work my job. I don't want to have a business forever. I want to rely on a passive income source. I want to do something online where I can travel. I can go where I please, right? So for me, I've been traveling for, 3 years now. But, let's go back to the wheel strategy. I want to sell puts right here at 150. So here's how I manage this position, okay? Because management is super important. A lot of people say, like, when do you get out of a position? And for example, when you do the wheel strategy, let's say you sell a put, and then the stock crashes and the stock goes way below, your average cost. Say, you sell this at 150 and say it goes down to 130. Well, you can't really run the wheel strategy. You can't sell 150 covered calls at that point because, well, there's not going to be any money there. They're just so far out of the money. So what do you do in that scenario? Okay, so we're going to talk about scenario analysis and managing your positions. And the first one is really the wheel. So if you sell a put option at 150, you're collecting income. So what I'm going to do is pretty much do nothing until the expiration date. Okay. Now, if this was a large position on margin, then I would roll this put option down. If J&J, for example, went down to 148, 149, anywhere around 150, and I started to get the emotion, because again, trading is not a science. It is also based on intuition, emotions, and experience. So for me, when I start feeling like, and I start seeing both, right? Feeling and seeing that the stock is not in a good momentum, okay? So for example, if I open up Yahoo Finance, let me show you an example of bad momentum, okay? And for me, I like to use RSI. So I like RSI a lot because it gives me a good sense of where the momentum is at, but I can also clearly see the direction of a stock's movement. So as you can see here, I'm looking at the moving average, okay? So for me, I use 50-day moving average. Now, on Wall Street, I have seen 30-day, I've seen 60-day, I've seen 90 days, okay? I wouldn't say one is better than the other. They're just different. There are different angles, there's different lenses to analyze a stock. But for me, I like to use 50, and that is the default of Yahoo Finance as well. So when I see a stock coming down, for example here, and it crosses the moving average, that is a sign to me to sell, okay? So I would sell, and this has been a very big part of my strategy. In my Discord, for example, whenever I see a stock cross the moving average, that is a very big sign for me to either buy or sell. I mean, it is a heavy contributor. Now, I would say maybe that's about 20%, maybe even a quarter percentage of my decision. I do look at fundamental analysis, which we will also talk about in this video, but when I see a stock crossing its moving average, that is a bad sign. As you can see here, this was a very indicative sign of Johnson & Johnson just completely breaking down. I mean, the stock broke down. Now, for one reason or another, fundamentally, there was probably some reasons. There was probably also reasons in the news, right? I mean, it could be announcements, and that's another reason why I don't really love healthcare, is one big announcement could either crash or make the stock go up to the moon, and I don't really like that. I'd rather just have a predictable source of income and not have to kind of like gamble. But still, looking at Johnson & Johnson, it is surprising how much a blue chip company that is super stable, diversified, and is basically all over the world, right? And they're still down a very significant amount. But for me, when it crosses the moving average, that is a sign to get out of the stock, okay? That is a sign for me, okay? But still, right now, what I want to point out is the heavy volume. As you can see here, the little red bar chart thing here is there was a lot of heavy volume. There's a lot of selling. So all the people that were basically not super confident on the stock and started to have a lot of fear, they got out. And again, more fear here. So now we see the stock recovering, and you can see a strong base formed at around 150 per share. So for me, this is a no-brainer. This is a no-brainer trade. I will sell a 150. Now, can it go down to 140, right? It can, of course, but what I'm going to do in most scenarios is just hold this and then start selling covered calls. Now, what will I do if this stock goes down to 130, which is super unlikely? The chances are, well, let's see what the chances are actually based on options. The chances of it hitting 130 would actually be 3%. So only about 3 out of 100 times would a stock like this completely crash down to 130. But if it did, what would I do? Okay, so what I would do is I would wait until it would recover, because I only sell puts on stocks that I want to own to begin with. So if a stock falls down so much that it's now undervalued, like extremely undervalued, as you can see, it would be lower than it's been. Let's go to the 1-year chart. It would be a 52-week low. Let's go to the 2-year chart. Okay, it would be a 2-year low. Okay, so this would be at a 2-year low. I would not actually sell covered calls. I would kind of honestly abandon my wheel strategy, because A, I'm not going to get any money for 150. And if you do want to make income on a stock that crashed, you basically have to be okay with selling covered calls below your cost basis. So say I sold a 150 put, it's at 130 on a different stock, not J&J, because I think it would be silly to do covered calls and sell J&J for 140. But let's say you have a different stock, it went down to 130. You have to basically sell 140 covered calls, and that is below your cost basis. But that's just something that you have to kind of deal with. And to be honest, there is ways around it though. And one way around it would be rolling. So let's just take an example. Let's do American Airlines, which I've been making money on very, very consistently in the Discord. I mean, I've done it over and over again. And I actually want to pick this stock because although I am up on this stock because I've been selling so much options, you can actually see that recently my average cost basis is $15.50. It is $15.50, so I'm below my average cost basis, but you can see that I have sold a 14.5 call option. So I have literally just picked my biggest wounded stock or my biggest issue in my portfolio, which is American Airlines. I just know on top of my head, and that's because I sold a covered call at 14.5, but American Airlines is now 14.74. So I'm in that exact scenario that I just talked about, which is selling puts to get in, and then when a stock goes down significantly, right, I don't really have a choice to sell 15.50 at the time, right? So when I sold this 14.5 call option, let's just look at the exact day that I sold it. I sold it on March 27th, which was actually about a week ago. And we go to American Airlines. In the past 1 week, the stock is up 5.59%. So a pretty significant move for a fairly stable company. I mean, if you look at the 1-year chart, this is a very stable company. So, you know, I sold a covered call, and now I'm kind of dealing with the consequences because the stock is above the call option that I sold. So what will I do? How will I manage this? Well, here's exactly how I'm going to manage it. So as soon as Monday opens up, which is tomorrow, and I go on my live trading call, what I'm going to do is I'm going to go to roll this position, okay? Because I don't want to sell American Airlines at 14.50. I want to keep the gravy train going, and I want to sell it maybe for 15.5. So what I'm going to do is I'm going to go to roll this position, and this is exactly how you want to manage, you know, a bigger portfolio. You want to do the wheel strategy for the majority of your money, and then if you ever get caught like this, like I just got caught right here, what you want to do is you still want to manage and adjust this position by rolling it up. So this position is expiring on 4/6. What I'm going to do is I'm going to go to April 21st, which is, you know, not even 3 weeks away. And now I can sell the 15.5. Okay, I can sell the 15 for a profit actually. If I sell the 15, I will collect $16 here. Okay, so I'm actually collecting $16 and moving from 14 and a half to 15. And then guess what? When 421 comes around, if American Airlines is above 15, I can do this again. I can roll the 15 to 15 and a half. The next month I can roll from 15 and a half to 16. In the following month I can roll from 16 to 16 and a half. I can continuously roll up infinity times. So when I am running the wheel strategy, it is very important to understand rolling, which I do have a video on. You can look at that in the description. But for me, rolling is such a key. And rolling doesn't have to be hard. It's as simple as this. I see a $14.50 call option. Now I can roll to 15, and I'm gonna go out, let's say 2 weeks, okay? Now in the future, if this hits 15, I can go out another 2 weeks or even 30 days. And I have done this over and over again to basically make a lot of money. I have made a lot of money by rolling continuously into infinity. You can see in my portfolio right here, most of my positions are actually for a gain. You know, I do end up winning about 80 to 85% of my positions, but I will end up rolling, and I will even end up rolling spreads occasionally. But for me, I do like to hold spreads until expiration, and that's a big question I always get is, do you hold this until expiration? Should I take profit early? For me, I always say you can't go broke basically taking profit. It's okay to take profit, but if you want the absolute biggest raw return, I like basically not closing at all. The ways I manage my positions are actually a hands-off approach. I like to not manage my position and usually not close it. However, some positions I do have to close. So if I'm running the poor man's covered call strategy, I absolutely want to close it, okay? But for bigger positions like the wheel strategy, I don't want to close the position. I just want to let it run, and towards the end of its expiration, I may end up rolling higher like I just showed you. And for me, it actually reduces standard deviation risk. It really reduces overall variance, because when you're trading more, you actually get less results in most cases. Now, it's okay to trade more with a smaller portfolio, especially if you're doing strategies like the butterfly, you're doing strategies like spreads, you're doing straddles, which, by the way, I love straddles. I do straddles from time to time, especially on earnings. You know, for me, I use OptionsFi. I trust the software. My friend built it. I contributed to the algorithm. So I really like it. And what I learned, because we both worked at Goldman Sachs, was it is actually super profitable to buy call options for earnings events. I mean, Goldman Sachs has proved, I think the stats were, I don't remember if they were 98% or 108%, but they were really ridiculous high returns for buying options before earnings. And that's because, clearly stocks have, big returns for earnings. For example, like Apple, here we're getting a call credit spread, a debit put spread. I would come in with a debit put spread. Now, that is something that you have to spend money on, but it's okay, because if you spend a little bit of money sometimes with your profits, right? If I'm picking maybe Amazon, etc., right? These, and actually you can see the implied move right here. So the implied move is not that big. It's only 1.89% on Apple. On Amazon, it's 3.38. But sometimes, tech stocks, and as you guys know, if you look at a stock that has earnings, sometimes the stock can report a good or bad event, and it could go up, 8%, 10%, 15%. I think recently Snap had a really big movement, and I was bearish on Snap for a long time. So in my community, I basically avoided this stock for as long as I could. I really haven't had it since it was like in the 40s. I did trade it briefly in the 40s. We made some money. I think it was like a weekly trade, and then I've not touched it. And as you can see, just complete breakdown. And that's not a bad thing if you're doing something like a put debit spread. So basically for me, I will buy call options, and I'll actually sometimes buy put options. Like on Airbnb, I was very bearish on that stock for a long time. I ended up buying put debit spreads. I can in fact show you my history. For me, I like to be transparent, so I don't want to just talk at you. I want to show you my history on Airbnb. And I know that I ended up doing a put debit spread because I was very bearish on Airbnb. I just saw what happened with Facebook. I saw what happened with other tech stocks. And yeah, there it is, actually on my birthday on October 31st. I ended up buying a put debit spread for $1,200, and just 3 days later, I ended up closing the position for $2,250. So it was about $1,000 gain. And again, guys, if you're trading with six figures, like, you don't want to do this with most of your portfolio. Like, I always tell people when they join my Discord and they see my trades, is I can't promise this. I'm not going to do this every day. Like, it's just impossible. Anyone that's going to promise you to make $1,000 a day out of 1,000 is just like, they're completely lying to you. They're just like either scamming or lying. It's ridiculous. You can have really good plays like this, and I do this on a quarterly basis. Every time I see earnings, I'll make some plays, but I mean, it's not possible to just buy options and have these type of returns on a weekly basis. It's not. I mean, you can't double your portfolio every week. If you could, I mean, I'd be doubling my 2 mil to 4 mil in a week, right? I'd have a yacht, a mansion, I don't know, right? It is impossible to have really huge returns. And actually, let me correct myself. I wouldn't say that it's completely impossible, but you would be doing it at a very high risk, and it would not be worth, you know, the return, because essentially you could take massive risk just like a casino. You can bet on a single number on a roulette table and get a 36x return, right? You can just bet on number 18 or number 22 and you can get a return that's 36 times. But again, your chances of winning is very slim. Your chances of winning actually are 1 in 38 because a roulette table has 38 slots and there's only 36 that can win. That's how the casino, by the way, makes money. Right? They make money by having a slight advantage, just like blackjack. The blackjack odds are 51 to 49. But if you can be the casino and you can sell options, you're going to have a really big advantage. Okay? So that's what I like to do. That's what I teach, is basically selling options, because then you can kind of be like the casino. You can collect small amounts of money consistently. And if you can collect $100 to $500 a day, that really adds up. To me, that's not even small money. I mean, that's money that you can live on in a foreign country. You know, I've traveled all over Europe, South America, and, you know, $100 a day goes really far. And I'm sure some of you guys, you know, in America, you guys know that if you're from a foreign country, $100 to $500 a day can go really far. So for me, I'm always focused on diversifying my portfolio. And that's what this is about. Having proper asset allocation, because you don't want to just go all in on one stock like Tesla. And I've had a man that I was working with who had a $50 million portfolio. He had 50 million and he had it all in Tesla at the peak. And I was telling him, you should really diversify. Now, despite the man being smart enough to gain that money through businesses and entrepreneurship, he was not smart enough to keep the money. Okay, there's two different things. You can make money and you can keep money. I'm very good at both. I'm good at making money in my portfolio consistently and keeping it. And some people, they just don't understand this concept. They're all about, how do I make a lot of money? And they don't think about keeping it. And that's where you find people that, you know, I worked with, you know, folks that have 600,000. And then by the time they get to me, you know, they say they watch my videos, and by the time they start coaching and seeing my trades, they end up losing half their portfolio, $300,000. And, you know, it's best to be proactive. It's best to have proper asset allocation, proper risk management. For me, risk management is having at least 12 to 15 positions. If you have less than 15 positions, it's not that smart, okay? Especially if you have a lot of money. If you're working with 100 to you know, $1 million and you have 3 positions, that is awful. That is a very big bet on a couple positions. You want to have multiple. So as you can see in my portfolio, I have American Airlines, I have Amazon, I have Google. I'm doing QQQ, put credit spreads here, which are doing pretty well on a small amount of capital. So as you can see here, I only put up 254 times, that's about $1,000, and I collected 50 in a week. So, you know, that's a little bit over a 5% return. So again, you don't have to just make small money. You can definitely go a little bit bigger, but if you're gonna do spreads and you have $100,000, you should not go more than 10% of your money in spreads. Like, you should have 10,000, no more, in spreads if you have $100,000. If you have $1 million, then you might want to go even lower. You might only want to have 5 or 6% of your money in $1 million. So that's 50 to 60 grand worth of spreads. And spreads are awesome. Again, you can make 10% a week on spreads. And I did grow my portfolio, and I'll be fully transparent and honest. I grew a lot of my portfolio because I did spreads on Tesla. Back when Tesla was growing like gangbusters in late 2020, 2021, I was doing put credit spreads and I was collecting 10, 15% a week. And at the time, even though this wasn't that long ago, I didn't really care because I knew that I'd be working for the rest of my life because I love working, I love coaching, and I knew that I'd be fine because I had a long time horizon. So I was willing to take higher risk, and that higher risk really paid off. It paid off big time because I was able to make 15% a week. You know, some months were 40%. In that year, I started with 100,000. In 2021, I ended the year with 700,000. But was that smart? I'm not sure. I'm not sure I would do that again because I did take excessive risk in 2021. I think, you know, I do want to kind of step back because I did do a lot of research on Tesla. I was very confident that it would go up, but I didn't even follow my own rules of risk management. I kind of broke a lot of rules. So I want to just educate you and let you know that you should be wise on how you invest with asset allocation, with risk management, with managing your portfolio. So for example, even if you have 5% of your portfolio in spreads, you still don't want to have it all in one spread. So for me, QQQ is just a $1,000 position. Adobe is a $500 times 8 is $4,000 position. Here, 5,000 times 15, $7,500 position. On Netflix, we have actually been very profitable. We've opened up positions that have expired, but our current positions are down. And that's okay because they're not huge positions. As you can see, my portfolio is beating Wall Street, is beating billionaires, is beating millionaires. It's literally beating almost everybody. Every YouTube guru included, who just shows you their wins but not their losses, okay? People are too short-sighted, and I want to encourage you to kind of think more long-term. You want to have your money spread around, especially if you have 6 figures, because that's no joke. You don't have a choice. If that's money you worked for, you cannot lose it. You want to make sure that you grow that wealth. You want to make sure that you can rely on your portfolio in the future, just like me. I don't need to work. I work by choice. You want to be in a similar position where you are working on your hobbies and passions. You don't necessarily care as much about your active income. But at first, if you don't have a lot of money, you have to focus on active income. You have to work a job. You have to have a salary with benefits. You have to build up to the point where you can do this full time. And for me, this is a little bit crazy. I went full time at $100,000. That was very silly of me. It's silly. Okay, I should not have went full time at $100,000, but I took big risk and it paid off in life, okay? So big risk can pay off huge, but for the most part, I would recommend that you take the consistent approach, even if it takes you a bit longer than me. I've been investing for 9 years. My first 3 years were not good, okay? I didn't really know what I was doing. I had to go about it the hard way. It wasn't really until I had my internship at Goldman Sachs that I started to really understand that selling options is the way to go. Because before I was just kind of buying calls and praying. And now I have a system, I have a strategy, which is number one, the wheel. I am buying call options and I'm buying debit spreads for earnings. And I'm basically just, using options fine. I'm putting a small amount of money in, but I'm not going crazy. I'm not going crazy, okay? I don't do too much of it. I put in like 1 or 2% and that's it, I'm good. Okay, and I will, take advantage of call credit spreads for sure, because I think having both call credit spreads and put credit spreads in your portfolio is important. You want to have both. They both are useful because just in general, what I learned at Goldman Sachs was that just selling options in general works. Selling both puts and calls, and that's why you'll see in my portfolio, I am diversifying into selling puts on JD, which is a Chinese company, on Baba. I've made good money on Baba, really good money on Baba. And I'm doing it on tech stocks. I'm also doing it in consumer stocks like Oatly. I am basically in many different sectors, but I will be honest, I am very heavy on tech, and that is my choice. But I would say, in general, let's go back to SPY, where I'll wrap it up with how you should be investing 6 figures to 7 figures. You should be investing in different sectors. Now, I will also be clear with you. I have a large amount of money in SPY, $1.2 million in SPY. So SPY for me, it's like a big support in my portfolio. This ETF is diversified. It has 500 companies within it. So I don't need to spend all my time trading because I don't think trading should take over your life. I only trade 3 hours a week. That's it. I do it Monday, Wednesday, and Friday, and I do it live on my calls. I don't want to trade all day. I think it's totally unhealthy to be by your computer just staring at the screen, watching things move up and down. Nonetheless, it being stressful to watch your money, and it also doesn't make you more money to stare at your money all day. So for me, I love safety, consistency, and stable companies and ETFs like SPY. So if I can run, this is actually a covered strangle, okay? This is something that I've taught a lot in my community, is a covered strangle. It's basically this, okay? So say you have shares of a stock, okay? So I have SPY shares, I have 3,000 shares, which is a whole lot of shares, right? But I don't know, some clients have way more shares than I do. But anyways, so what I do is I hold these shares and then I am selling covered calls. So as you can see, I'm selling the 402 covered call, which is actually in the money, meaning that I'm gonna have to roll it up this Monday. It's actually not good. This was another distractor at the moment, but in general, I have done phenomenally on SPY because this whole past 3 months, SPY is 6%. I've been selling options making 3 to 4% a month for the past 3 months. So I'm way higher than this S&P 500 return. But as you can see, overall on the stock itself, I am down, and I'm going to have to roll this covered call. But back to what the covered strangle is, it's basically doing covered calls and then also selling puts on the same stock. So I'm still selling puts on SPY. I am doing this on margin, and margin is a whole can of worms. I won't recommend it to most people. I always tell people, even when they join my community, it's, hey, you still have to do 6 months of consistent profits before you start using margin. But once you know what you're doing, you can use margin safely. And you can see that all the time in real estate. I mean, people are buying houses for $1 million. They're putting $200,000 down, taking an $800,000 loan, and nobody seems to complain about real estate. But once I say that on my $2 million, I am leveraging and borrowing $500,000, which is 25%, people lose their mind. Oh, you're doing something risky and crazy. Well, actually, based on my facts and results, I'm not. I am borrowing money using margin, and my portfolio is still moving less than the S&P 500. I am literally using margin and having less volatility than everyone else who's not using margin. Margin is a whole topic that I want to cover, especially when I'm working with you hands-on, because people can really get in trouble with margin. So I don't want to go into full detail on YouTube about it. I think margin is one of the riskiest things that you can do, but if you know what you're doing, it's also literally the safest thing that you can also do. I read this research report by Yale economists. I can no longer find it, but Yale economists, PhDs, researchers who are very risk averse, they literally said that most investors should be invested 110% in the market. And if they're not, they are missing out on long-term gains. And that's what I've been following for a very long time. I've been using leverage, and I've been using safe strategies like covered calls, selling puts, the wheel, safely using spreads, sticking to selling strategies, sometimes buying calls and debit spreads only on earnings. And I've been using this to have consistent results. If you want to have more consistent results, fix losing positions, I really think you should check out my video on rolling right here.